Hello students, welcome to the series on business environment. The topic of this lecture is fiscal policy. This lecture is in continuation with the last lecture. In the last lecture, we had studied taxation as the source for public revenue for the government. The objective of this lecture is to make you understand public borrowings, public expenditure and deficit financing. Public borrowing is another important source for collecting public revenue for the government. It is important to understand that public borrowings are different from taxation. The first difference is that the borrowings from public must be repaid. Public borrowings may be considered as fundraising exercise, whereas taxation is income proper for the government. When we say that the public borrowings must be repaid, it means that the repayment will require raising resources in the future. The government can raise public debt either as a voluntary loan or compulsory loan. Voluntary loan is secured by the government by issuing various types of bills and securities in the money market. The government has to do so because public expenditure is rising at a much faster rate than the incomes through taxes. To meet this deficit, the government is bound to raise loans. Developing countries like India require massive resources to carry out the development programs. So, the public loans are necessary as these loans build up the repaying capacity of the public authorities. For example, construction of roads, railways, canals and other irrigation works, installation of power plants, building up of heavy and capital goods industries, etc. through public loans is justified since such expenditures are productive and help in building up the capacity to repay the loans. Expenditure on schools, hospital buildings, etc. are not productive in economic sense, but are highly beneficial to the society as highlighted by S.K. Mishra and V.K. Puri in their book Economics of Development and Planning. Therefore, such projects are financed through public debt. Because if these projects are financed through taxation, then the current generation will only pay the taxes, but the future generation will reap the advantages of it. So, the burden is on the current generation. Also, a low level of national income and savings provide a limited scope for higher taxation, while demand for public expenditure is ever increasing. To meet the ever increasing deficit in public expenditure and tax revenue, reliance on public borrowings is increasing in developing countries like India. As mentioned earlier, there are two types of loans, that is voluntary loans and compulsory loans. The scope of voluntary loans in developing countries like India is very low because the general level of incomes and saving is low. Thus, the government raises compulsory loans at times. Compulsory loans can be raised at the time of severe inflation to restrict total spending power in the hands of few people. Bonds are issued by the government for the period of 5 to 10 years, having a tax-free interest payment as compulsory loan. According to S.K. Mishra and V.K. Puri, employees' contribution to National Social Security or Provident Funds is also a form of compulsory lending since contributions to such funds are compulsory. The money goes to the government and the employee gets his share only at the time of retirement or on the occurrence of certain specified event. The Government of India introduced Compulsory Deposit Scheme or CDS in the year 1974. This scheme covered all income tax payers whose aggregate net annual income exceeds Rs 15,000. The objectives of CDS were restraining conspicuous consumption in cases of people in the higher income brackets and generating additional resources for the government. But this scheme was withdrawn in the year 1986. Besides the voluntary and compulsory loans, there are two other types of loans which the government can raise, and these loans are internal loans and external loans. According to S.K. Mishra and V.K. Puri, the government can raise loans from within the economy itself or can borrow from other countries. Foreign borrowing is often resorted to by the developing countries in order to supplement their resources for carrying out the developmental programs. Such borrowings also become necessary to bridge the foreign exchange gap that emerges on account of rapidly rising import expenditure and constant export incomes. Export earning of India becomes slow while the urge for industrialization leads to increase in import of capital goods and machinery. Thus, a gap between foreign exchange payments and receipt emerges, which is filled up through the foreign borrowings. Foreign loans help the developing countries like India in carrying out the development programs, but continued dependence on these loans reduces the economic independence of the developing countries and increases the uncertainty in the whole process of planning. The disadvantages of the foreign loans are they reduce the freedom of the receiver country to purchase in the cheapest markets. The country is often forced to buy several inessential goods as a part of the package deal. In many cases, foreign loans are country tied or project tied, reducing the freedom of the country to use them in the manner it deems fit. Foreign loans are often received on year-to-year basis, destroying a lot of flexibility required in planning and introduces the element of uncertainty. The country is often subjected to a lot of humiliation and economic political pressure by the donor country, eroding its capacity to follow independent policies. An instance given by S.K. Mishra and V.K. Puri in this regard is that the donor countries and the international aid agencies like the IMF or World Bank have been forcing India in recent years to open up its economy for the foreign competition. Perhaps the biggest disadvantage of the foreign loans is that continued dependence on them for a number of years increases the burden of repayment, and servicing the foreign debt creates different problems for the government. More so because repayment and servicing have to be done in foreign exchange. Most of the times, the recipient countries fail to generate adequate resources through development programs to repay the debt. In such situation, they are obliged to obtain fresh loans to repay the older loans. Or we can say that fresh loans are taken not for developmental purposes, but for meeting the debt servicing charges. Another tool of fiscal policy is forced saving. This concept was introduced during the period of Great Depression of the 1930s to help the depressed economies of Western Europe. It is popularly known as deficit financing. Western developed countries use this tool whenever there is an excess of expenditure over current revenue receipts. So it also includes the coverage of budgetary gaps through loans. In India, deficit financing occurs when the government spends more than what it receives from the public in the form of tax and non-tax revenue, which includes public borrowings, fees, and profits of public enterprises. In developed countries, deficit financing raised the level of effective demand in periods of depression, while in developing countries, it mobilizes savings and utilizes the ideal resources. The two factors increases the level of savings and a higher rate of capital formation are essential to spur the process of economic growth in the developing countries like India. In developing countries, the problem is the level of voluntary savings plus the resources raised by the government in the form of taxes, public borrowing, and external finance are much less as compared to the needs for investment. Therefore, this gap has to be filled through deficit financing. Deficit financing may help in promoting the level of economic development in the developing countries like India. Deficit financing involves creation of money. It may result in inflation also. While newly created money leads to an immediate increase in the purchasing power in the hands of people, the production of goods does not increase simultaneously. It takes time to build the capital requirement and generate additional volume of goods in economy. So, the experience of the developing countries is entirely different from that of the developed countries in the depression phase. Hence, in the case of developed countries, the capital equipment and other necessary resources for production are already present, only the aggregate demand is insufficient. Therefore, when additional purchasing power is pumped into the economy, through deficit financing, the level of aggregate demand increases and the capital equipment laying idle is utilized to increase the level of production. If this increase is able to match the increase in the aggregate spending level, inflationary tendencies will not be generated. Whereas in developing countries like India, the capital equipment does not exist, but has to be built up. Therefore, there is considerable time lag in the generation of extra purchasing power and the availability of additional consumer goods. In the meantime, the level of prices increases. According to Meyer and Baldwin, capital accumulation through deficit financing is likely to generate inflation, also because in developing countries the propensity to consume is high, there are many market imperfections, there is a little access capacity in plant and equipment, and the elasticities of food supplies are low. Because of the general poverty of the masses, their level of food consumption is low. Their first temptation is thus to spend more on food consequent upon an increase in their income. However, it is difficult to increase the supply of food items in short run. The demand for food items is likely to be pushed up to a far higher level as compared to their supply, resulting in a rise in their prices. As highlighted by S.K. Mishra and V.K. Puri, in developing countries, prices of food items work as signal for the prices of other goods and they also start rising. The high propensity to consume compounds the inflationary impact of deficit financing as a substantial proportion of the increased income is spent on consumption. Because of market imperfections, the composition of total output and the production structure of the economy remains much more fixed over time in developing countries as compared to the developed countries. This results in low elasticity of supply of output. If additional resources generated through deficit financing are utilized for the production of consumption goods, the inflationary impact is likely to be restricted as the additional created money supply will be matched by an increased amount of consumption goods. Examples of programs wherein increased expenditure is not likely to result in inflation are small scale enterprises, distribution of new high yielding variety of seeds, fertilizers, etc. to farmers, minor irrigation schemes, etc. However, the important task before the developing countries like India is not to increase the output of consumption goods, but to build up costly capital equipment. Laying down railway tracks, improve communication facilities, build up huge hydroelectric and thermal power plants, etc. Therefore, the extra money created through deficit financing is likely to be spent on financing these projects. As a result, there is no likelihood of an increase in consumer goods in the near future, and inflation would almost inevitably result. It is because of this potential inflationary effect of deficit financing that it is termed as inflationary method of financing growth. Deficit financing is different from taxation. For the government of developing countries, deficit financing is an easy instrument of financing development expenditure. Developing countries rely very much on this instrument, and as a result of which they are reeling under the burden of inflationary pressure. It is easy to start an inflationary course of development, but very difficult to control it. Therefore, these countries should depend more on raising resources through taxation than by following the inflationary method of financing. This is because of the reasons like, although taxation, particularly the indirect taxation, leads to rise in prices, its effects are likely to be much smaller. Dependence on taxation involves a certain amount of monetary discipline, which is invariably lost as government resorts more and more to deficit financing. The incidence of taxation can be controlled more fairly and efficiently than the incidence of inflation, and continuous price inflation moving domestic costs out of line with world prices can be a major source of economic stagnation. Now let us discuss the role of public expenditure. As mentioned in the last lecture, the role of government was earlier confined to maintain the law and order and leave the whole field of economic activities to the private sector. According to S.K. Mishra and V.K. Puri, the Great Depression of 1930s and the widespread condition of unemployment proved that if left to itself, the private sector cannot pull out the economy from the low ebb of stagnation. Therefore, the state or the government had to participate directly in increasing the level of investment through creation of various public works programs. After the Second World War, many of the Third World countries embarked upon ambitious programs of economic development. They realized that the private sector does not have either the willingness or resources to invest in infrastructure such as laying of railway tracks, power generation, development of communication facilities, etc. The investment in such projects are very heavy while the returns are low and occur after long intervals. However, without these, no long-run programs of industrialization can be sustained. Similarly, investment in basic and capital goods industries is also necessary. Their establishment requires heavy investment while returns are low. Therefore, the responsibility of building up the infrastructure of the economy and large capital goods industry is to be borne by the government. This will require massive expansion in the public expenditure, but some supporters of private sectors, as mentioned earlier in the previous lecture, argue that increasing participation of the government in productive activities discourages the private sector. But this is not true because public expenditure can help the expansion of private sector in many ways, like building up of economic infrastructure and basic and capital goods industry creates the necessary environment in which the private sector can operate. In absence of power, transportation and communication facilities, productive activities cannot be carried out in private sector. Similarly, in absence of basic and capital goods industry, bottlenecks in the supply of machinery and other intermediate goods, the growth of private sector will be hampered. Thus, the process of initiating, sustaining and promoting economic development in India depends crucially on expanding public expenditure. It is to be noted that the increasing programs of industrialization can be sustained only if the agricultural production and productivity expand at a sufficient rate to meet the requirements of the industrial sector in India. If shortage in agriculture production and productivity emerges and persists for a long time, the pace of industrialization programs will slow down, and because of the shortage of wage goods and raw materials, this situation will arise. So, India should spend considerable sum of money on the agriculture sector to increase agricultural production and productivity. At present, the government is bound to fulfill social obligations like the provision of cheap housing facilities, cheap or free public health services and education, etc. So, the additional expenditure has to be made towards provisions of these facilities. The government should keep the fact in mind that such expenditure will improve the level of productivity in the long run. Indian economy tries to improve the distribution of food grains and some other consumer goods through the public distribution system so that the poor can get their requirements at low prices. This leads to increase in public expenditure as new fair price shops have to be opened up and storage and warehousing facilities have to be provided at various places. The government also tries to reduce regional inequalities and imbalances as between different regions. For this purpose, industrial location policy has been used to divert resources to the backward areas of the economy, and industrial estate have been built up in such regions in India. Industries set up in industrial estate are granted subsidies and incentives in various forms. The central government also provides grant in aid to backward states. All these attempts to reduce regional inequalities result in an increase in public expenditure. Now let us talk about interrelated monetary policy and fiscal policy. According to S.K. Mishra and V.K. Puri, ever since 1930s, when the role of fiscal policy was first recognized in the right perspective, it has been given increasing importance in both developed and developing countries. In the depressionary condition of 1930s, it was found that cheap money policy had proved ineffective to induce private investment. It was suggested that private investment could be stimulated by creating new community income through deficit spending. Later, the role of deficit spending in checking chronic tendencies towards over-saving and underinvestment was duly emphasized. After the Second World War, the developing countries have found in this instrument, that is the fiscal policy, an easy way to raise resources for economic development. Therefore, through originally conceived to supplement monetary policy, fiscal policy has tended to supplant it. The consequent neglect of the monetary policy has had various harmful effects on the economies of the developing countries. The most important being the reckless monetary expansion accompanied by the inflationary rise in prices. High and ever increasing prices in many developing countries have encouraged speculative activities and undermined the confidence of the people in their currencies, besides creating numerous problems in the planning process. This points to the necessity of evolving a judicious mix of monetary and fiscal policies. According to Robert B. Banks, perhaps a judicious mix in the context of a developing economy will involve a tight fiscal policy combined with a fairly easy credit policy. A tight fiscal policy ensures that an ample volume of resources is generated to finance public expenditure programs, while an easy credit policy ensures the private investment is not allowed to suffer on account of inadequacy of loans. Such a policy has an additional benefit that it is less inflationary as compared to the alternative mix of policies, since private investment generally adds to output more quickly than public investment. In the next lecture, we will discuss the compensatory fiscal policy and the fiscal issues in India. Thank you.